In March 2021, Bill Hwang was worth $20 billion. 48 hours later, he was worth zero. And the world's biggest banks lost $10 billion they didn't even know they'd lent him. No one saw it coming because no one knew he existed. He wasn't running a hedge fund. He wasn't on any Forbes list. He was invisible, operating in the shadows, borrowing from everyone, answering to no one. This is the story of the invisible fortune that almost crashed Wall Street. Bill Hwang arrived in America from South Korea with nothing. By his 30s, he was managing billions for Julian Robertson, one of the most legendary hedge fund managers alive. Robertson ran Tiger Management, the firm that trained Wall Street's elite. Hwang was his golden boy. In 2001, Robertson gave Hwang $25 million to start his own fund, Tiger Asia Management. Within a decade, Hwang turned it into $10 billion. He was trading Asian stocks with surgical precision, living the dream. Then came 2012. Federal regulators caught him running an insider trading scheme. He settled for $60 million, got banned from trading in Hong Kong, and shut down his hedge fund. Most people would disappear. Hwang went invisible. He converted his operation into a family office, Archegos Capital Management. Here's why that matters. A family office only manages your own money, not outside investors. No regulators watching. No disclosure requirements. No one asking questions. Using a trick called total return swaps, Hwang rebuilt his empire. Here's how it works. You want to control $50 billion in stocks, but only have $10 billion. You go to a bank and say, "You buy the stocks, I'll pay you fees. We split the profits." The bank owns the stocks on paper. You control them in reality. Because the bank owns the stocks, you don't have to tell anyone. Normal investors who own more than 5% of a company must file public disclosures. With swaps, you're invisible. Hwang ran this trick at 5 banks at once: Credit Suisse, Morgan Stanley, Goldman Sachs, Nomura, Deutsche Bank. Each bank thought they were his only lender. None knew he was using their money to buy the same stocks over and over. By March 2021, Hwang controlled $36 billion in stock positions with only $10 billion of his own money. 5-to-1 leverage. His net worth hit $20 billion. He was one of the richest investors on earth. Almost nobody had heard his name. He was betting everything on volatile media and Chinese tech stocks. ViacomCBS, Discovery, Baidu. These weren't safe companies. They could swing 20% on a headline. But the stocks kept rising. He kept borrowing. The banks kept saying yes. Total return swaps aren't illegal, but Hwang weaponized them. He turned a financial tool into a regulatory cheat code. When you borrow from 5 banks and none know about each other, you're not diversifying risk. You're concentrating it. You're building a house of cards where every card is borrowed. Imagine you own a $10,000 car, you borrow $50,000 from Bank A against it, then $50,000 from Bank B, then Bank C. Eventually, someone asks to see the car, and everyone realizes they're lending against the same asset. That's Archegos. Court testimony revealed banks extended Hwang billions based on what prosecutors called pinky promises. They didn't demand to see his full portfolio. They didn't ask who else he was borrowing from. They trusted him because he'd made them money. Hwang was convinced he couldn't lose. He'd rebuilt his fortune once. He'd beaten the market for years. He told colleagues his picks were home runs. He refused to sell positions or reduce leverage. Every warning sign he ignored. The psychology is textbook. Pride. The belief that past success guarantees future success. Hwang thought he'd found a system. He was just luckier until his luck ran out. March 22, 2021, ViacomCBS announced a surprise stock offering to raise cash. When you flood the market with new shares, the price drops. ViacomCBS fell 9% in one day. For a normal investor, that's painful. For Hwang, it was catastrophic. With 5-to-1 leverage, a 9% drop meant a 45% drop in his collateral value. The banks saw their risk exploding. They called Hwang, "We need more cash." Now, Hwang didn't have it. He'd bet everything. No cash reserves, no safety net. He got on a conference call and told banks he could quickly unwind positions. He'd sell some stocks and everything would be fine. He was lying or delusional. His positions were so massive that selling them would crash prices further. It's like quietly selling 1 million concert tickets when everyone knows the band broke up. The act of selling destroys the value. The banks started talking to each other. They realized they'd all lent Hwang billions for the same stocks. The risk wasn't divided, it was multiplied. March 24th, the banks stopped waiting. They started liquidating, selling Hwang's positions before the other banks could. A race to the exit. In a race to the exit, everybody loses. Block trades worth tens of billions hit the market. ViacomCBS collapsed 57%. Discovery dropped 27%. Each sale drove prices lower. Lower prices triggered more margin calls. More margin calls forced more sales. A death spiral, 48 hours. That's how long it took for Hwang's $20 billion to evaporate. By March 26th, Archegos was finished. Bankrupt. Gone. Credit Suisse lost $5.5 billion. Nomura lost almost $3 billion. Goldman and Morgan Stanley escaped with smaller losses because they sold faster. Thousands of bank employees lost their jobs. Credit Suisse, already weak, would collapse into UBS 2 years later. Archegos was gasoline on the fire. April 2022, prosecutors charged Hwang with 11 counts of fraud. July 2024, a jury convicted him. November 2024, a judge sentenced him to 18 years in prison. His lawyers called it a tragic mistake. The judge disagreed. This was a calculated scheme that risked the entire financial system. Here's what every investor needs to understand. This wasn't random. This was predictable. The red flags were neon bright. Lesson 1. Leverage is a loan shark. It multiplies gains when you're right and annihilates you when you're wrong. Hwang used 5-to-1 leverage, meaning a 20% drop wiped him out completely. If you can't afford to lose your investment, you can't afford leverage. Lesson 2. Transparency is non-negotiable. Hwang's entire scheme depended on hiding information. He avoided disclosures. He kept banks in the dark. When someone structures investments to avoid transparency, that's not sophistication. That's a red flag. Lesson 3. Past behavior predicts future behavior. Hwang had settled insider trading charges for $60 million. He'd been banned from Hong Kong, and banks still gave him billions. 1 regulatory strike should trigger skepticism. 2 should be disqualifying. Lesson 4. Concentration kills. Hwang bet everything on a handful of volatile stocks. When they dropped, he had nowhere to hide. Never put more than 5 to 10% of your portfolio in a single investment, no matter how confident you feel. The Archegos collapse wiped out $20 billion in personal wealth and cost banks $10 billion more. All because one man believed he was too smart to fail. He wasn't. Nobody is. The market doesn't care about your track record. It only cares about math. And the math always wins. Financial disasters happen every decade. The names change. The schemes get more complex. But the lessons stay the same. Subscribe so you don't miss the next collapse. Click the video on screen to see how Credit Suisse went from lending billions to Hwang to needing a rescue itself.